Hello friends, welcome to our channel Accounts and Finance with FARSK. This is our video on the set of videos on reading the financial statements 2 of 7, balance sheet 1 of 2. Hope you will like, share and special request to all to don't forget to subscribe our channel. Series on the set of videos reading the financial statements 2 of 7, balance sheet 1 of 2. Reading the financial statements balance sheet. Balance sheet is also known as a statement of financial position, and its purpose or main motive is to reveal the assets, liabilities, and equity of an organization. What are assets? The assets of a company are what the company uses to operate its business. What are liabilities and equity? The liabilities and of course the equity of the company are used to support the assets. The balance sheet is derived from its name from the following balance sheet equation, which is balancing assets with that of liabilities plus shareholders' equity. Therefore, the formula will be assets is equal to liabilities plus shareholders' equity. The balance sheet equation must always be in balance, meaning that the assets of the company must always be equal the sum of the liabilities and equity. The items on the balance sheet are presented in order of decreasing liquidity, which means that cash is shown first, followed by items that can be quickly or easily convertible to cash, etc. Assets. To begin our analysis of the balance sheet, we will look at the assets category. Assets are broken down into current assets and fixed assets. Current assets are items that are expected to be converted to cash within a 12-month period. Current assets include cash, accounts receivable, inventory, prepaid assets, and other current assets. Non-current assets are considered long-term or fixed assets. Fixed assets include equipment, buildings, property, and other long-term investments. Fixed assets may also include intangible items such as copyrights and patents. The first item in the current assets is cash. Cash. What is cash? Cash is a pretty simpler term. However, the cash referred here is not only cash but also cash equivalents, and is money in demand accounts in a bank or the current account normally called or on hand funds such as petty cash, accounts receivable. Remember that for many businesses, when a sale takes place, the transaction does not immediately generate cash. The business may offer terms to pay such as net 30 days or net 60 days or 90 days or 120 days, etc., as the case may be. This is normally used to offer more credit to the customers to bring in more business to the company. For manufacturing plants, say, when the product shifts or many contracting businesses, when the revenue is generated, the company will likely generate an invoice under IFRS 15, thereby creating an accounts receivable entry on the balance sheet. Only when the customer actually pays after the due date will the transaction be removed from the accounts receivables and transferred to cash in the balance sheet. Reserve for doubtful debts and bad debts. Sadly, some customers will never pay, so it is wise to create a contra account to accounts receivables known as reserve for doubtful debts and bad debts, which recognizes that some of the accounts receivables may be or may never be collected. The amount placed in the provision for doubtful debt accounts and bad debts is based on the prior experience of the company. Inventory. Inventory is that proportion of the asset or stock which is solely purchased for resale to customers. For example, if a furniture is purchased by the organization, it is fixed asset for the company. But when the same furniture is brought by the company in furniture business, then it is to be treated as an inventory. Inventory is related to the cost of goods sold on the income statement. Accounting principles state that inventory should be valued on the balance sheet at its cost or market price, whichever is lower. Normally, the inventory will be valued at cost, but if the inventory is obsolete, perhaps because of new technology, the value of the inventory may need to be written down to its market value or brought down to its market value. There are four accepted methods for valuing inventory: specific identification, FIFO, LIFO, and weighted average. Specific identification is the process of linking the sale of a product to a particular product in inventory. FIFO tends to help maintain the value of the inventory close to the balance sheet value. During times of rising prices, FIFO can distort the value of the cost of goods sold, leading to higher than expected income on the income statement. LIFO is last in, first out, and assigns the most recent inventory purchases to the cost of goods sold, that's COGS. This approach most likely or closely aligns the market selling price with the market value of the cost of goods sold. Since LIFO naturally assigns a higher value to the cost of goods sold, it has the effect of lowering the net income, which lowers income taxes due from the sale. LIFO is widely used because of the tax benefits. The IFRS permits the use of LIFO, provided the company uses this method for both tax reporting and financial reporting, which means that for showing more income, if you are reporting in the financial reporting as per the FIFO, and in the tax reporting, if you are reporting as a LIFO, it's not acceptable. The weighted average approach is to divide the total inventory acquisition cost by all units available for sale to arrive at a weighted average unit cost. The unit cost is used to determine the cost of goods sold or COGS value. The weighted average method is easy to use and produces a result somewhere between FIFO and LIFO. Any of these four methods are acceptable for recording inventory, provided the company is consistent in its application of the method. Prepaid expenses. Insurance premiums, rent, advertising, and other services that the company has paid for but not yet received the full benefit are known as prepaid expenses. Reading the financial statement, balance sheet. This is what this video is about. To be listed as a current asset, the prepaid expenses should expire within the next 12 months or the coming 12 months. Insurance premiums are one of the most common prepaid expenses that show up on the balance sheet, since insurance is typically purchased for a 1-year period in advance. As prepaid expense is consumed, example, every month for an insurance policy, the expense is recognized on the income statement. Long-term investment. Investments that will not mature for 1 year or more are considered long-term investments. The investments are recorded at cost but are subjected to write down if it is believed that the fair market value is substantially less than the amount recorded on the balance sheet and reduced on the balance sheet. Other current assets. This account is used to accumulate many small current assets that are not significant and do not warrant a separate account. In this case, the amount may be large but consists of numerous small transactions. Nonetheless, they are also called as other current assets and falls in the category of current assets. Well, that's it for today. Hope you like our video. For more videos, please do not forget to like, share and subscribe to our channel. Accounts and Finance with FARSK. Thank you. Have a great day.